Stop! Don't sign that mortgage yet. Folks, let's have a talk. You're shopping for a mortgage and you're laser focused on one thing, the interest rate. You see a low number, and your brain screams, that's the one. I won. Believing the interest rate is the only thing that matters is like thinking the price of a car is just the sticker price. It's not the whole story, not even close. You need to understand how the person selling you that loan, the lender, the broker, is actually getting paid. Because how they get paid directly impacts how much you pay. It's your money, your future, your house on the line. The mortgage world can feel like a magic show. There are smoke and mirrors everywhere. They throw around terms like points, origination, lender credits, and hope you're too confused to ask questions. But knowledge is power. And today, you're going to get powerful. We're going to pull back the curtain so you can see exactly how this machine works. When you understand the game, you can play it to win. We are not going to let that happen. Not on my watch. We're about to break down the two main ways lenders and brokers make their money. Bigger check at closing, or more each month. Neither is automatically good or bad, but you have to know which one you're choosing and why. Alright, let's talk about the first option. Borrower-paid compensation. The name says it all. In this setup, you, the borrower, pay the mortgage professional directly for their service. It's straightforward. It's transparent. This payment shows up as a line item on your closing documents. Plain as day. There's no hiding it. The most common fees you'll see here are the origination fee and discount points. Think of the origination fee as the lender's fee for the paperwork, underwriting, and processing needed to create your loan. Paying points is basically prepaying interest to get a lower rate. 1 point costs 1% of your loan. On $300,000, 1 point is $3,000 at closing. In return, your rate drops a bit. You pay more upfront to lower the monthly payment for the life of the loan. It's a trade-off, and you need to do the math. You'll have higher upfront costs, origination fees, and any points you choose to buy. But the big advantage is a typically lower interest rate. Because they got paid at the start, they don't have to build profit into your rate for 30 years. That can save you a massive amount over time. This structure is all about paying now to save later. Taking control and buying down the rate, the engine of your mortgage payment. You're telling the bank, I'll pay you for your work now so I can pay less in interest for decades. It's powerful, but only if you can do it without draining your emergency fund. Now for the other side of the coin, lender-paid compensation. This one sounds great on the surface, doesn't it? Lender-paid makes it sound like it's free, but there is no such thing as a free lunch. Your broker or loan officer is paid by the lender funding your loan. You won't see a separate commission line item. It's behind the scenes. The lender recoups that cost by building compensation into your interest rate. That means a slightly higher rate than you'd get with borrower paid. You pay less at the closing table, but more every month for as long as you have that mortgage. The upside, less cash to get in. If you're scraping together a down payment, lender paid can be the bridge from renting to owning. It's a strategic move if you won't be in the home long, or plan to sell or refinance in a few years. Let's dig into lender credits, the great closing cost trade-off. Your officer can offer a range of rates. The lowest is called the par rate. At par, you get no credits and pay your own costs. Bump the rate 0.25%, and the lender can give you, say, a $4,000 credit toward closing. They raise the rate above par, and use the extra profit to fund your credit. It's a powerful tool to buy now with less cash, but that higher rate can cost thousands, even tens of thousands, over 30 years. Run the numbers and know your break-even. Which loan is the best? The truth is, there is no single best loan for everyone. The right choice depends on your finances and your goals. It's a battle between paying more now or paying more later. If you've saved, have a cushion, and enough for down payment and closing costs. Borrower paid is often your best bet. Paying up front to lock the lowest rate can save a fortune long term. If cash is tight, lender paid or a loan with lender credits might be the right strategic move to get in and start building equity. In fast rising markets, waiting to save might cost more than the extra interest. And if you're sure you'll move in 3 to 5 years, upfront savings can win. You cannot, and I mean cannot, shop by rate alone. Compare official loan estimates from at least 3 lenders. Look at the interest rate, yes, but also total closing costs and Section A fees. Ask, is this borrower paid or lender paid? Are you increasing my rate to give lender credits? Be the detective of your financial future. You're in charge. Take a breath, look at the numbers, think about your timeline, and choose the path that aligns with your plan.